All right, we are live. Hello and welcome to all of our listeners. I'm very excited to be sitting with this group of experts today to understand how to value cryptocurrencies. It's a challenging topic on any day, but we are very lucky because we're joined by Jeff, Reto, and Katalin, who are all experts in the field. Jeff Dorman is the CIO and co-founder of Arca and has 20 years of experience in traditional finance and over 6 years in crypto. Reto Stiffler, who is the chairman at Crypto Consulting, who's had 30 years in financial services, 8 years in the world of crypto, and Katalin Tischhauser, who is responsible for all of the investment research that comes out of Sygnum Bank, who are all incredibly well equipped to answer some questions for us today. So thank you all very much for coming on our webinar. And let's already just dive straight into it. So I feel a good first question is, what gives cryptocurrencies their value in the first place? And I'll hit that over to Jeff.
Sure. First, I think you always have to take a step back first and define what we mean when we say cryptocurrencies. I don't even use that term. For those who know me, I always call them digital assets. And within digital assets, cryptocurrencies is one subset of the digital asset industry. Because a currency is obviously valued very differently than an equity-like instrument, which would be very different than some sort of loyalty reward card or some sort of a member reward type token. We've actually created a taxonomy for digital assets for that reason, to kind of help educate there. So when I think about how to value it, I like to break it down, at least at a high level, into three types of digital assets, right? A currency, in my opinion, can really only be valued relatively versus something else. Bitcoin has value relative to the dollar or relative to the euro or relative to the yen. It doesn't really have absolute value. And there's a host of other, currencies trying to do similar things to Bitcoin. When I look at how to value something like that, I look at it more like an option. If you think Bitcoin specifically, do you believe in a world where there's a complete loss of faith in local governments or banks to the point where you want to use some other type of denomination than your local currency? In which case, you almost using a Black-Scholes model, you could value what a future currency would be worth based on probability of that outcome. When I look at something that is more equity-like, and there are a lot of tokens that are like pass-through tokens, right, where they do pass through some form of revenues or profits, we value those the same way we value equities. We will use a DCF analysis. We'll use comparable comps. We'll look at dividend yields. There's a lot. MakerDAO is a good example just because it's topical right now. Maker's doing a couple $100 million of profits now simply because they're investing their treasury in short duration government bonds and earning 5% on billions of dollars of assets. That's a pretty straightforward calculation in terms of what the token is worth just based on the treasury and the income that they're earning from that. And then you have the probably the hardest one, which is your true utility tokens or member-like tokens, right? Where you're receiving some sort of non-financial reward for owning something, right? Similar to airline miles or similar to Starbucks points and things like that. And that's a little harder, right? That's where you kind of have to get into the supply and demand, right? How useful is this service that I'm getting, and how much of the token do I need in order to be able to utilize that? Almost a simple way to think about it is what is Amazon equity worth versus Amazon Prime, right? Amazon equity gives you the upside of the cash flows and the revenues of the business. You can value that pretty straightforward using cash flow analysis. But Amazon Prime is worth a ton as well, right? It gives you access to free movies and free music and discounts and shipping and all kinds of other perks, right? That membership is valuable. And the only way to think about that is, what would that be worth to someone else? How many Prime memberships are in existence? Is it infinite, in which case it probably holds less value, or is there a fixed amount, in which case, maybe being the first one to own that membership actually matters? So there's a lot of uniqueness with these digital assets, and you really do have to, read the white papers and figure out how these tokens accrue value and which value accrual mechanism makes the most sense.
Sure. Reto?
Yeah, if you have no idea where the value of a token should be, then probably for the first time you invest close to the top when everybody's talking about crypto, and then you probably use some kind of technical analysis, chart analysis. But there is a saying in crypto that the big players, the whales, they don't look at the chart, but they make the charts. And what I mean with this is that liquidity in crypto is still low, and the big players could really create certain chart formations, which they know that a lot of people look at. And then you see these strange, crazy movements, sometimes also called the Bart Simpson movements, where on one day you have a breakout and an increase in price, an explosion in price, and the next day it is completely reversed, or the next days it's completely reversed. So we don't say that you shouldn't look at technical analysis at all, but we think you should start with a fundamental analysis and then build a core selection of tokens, and then only in the end, if you want to do also some technical analysis to come to your final portfolio.
Katalin, you want to add?
Yeah, so a couple of things. So I think I have a similar perspective to you guys, and you know, maybe with some slight modifications. And I think the way I look at it is ultimately what will accrue value to that token. Is there something, and is there a mechanism for the value to accrue? For example, somehow you get a distribution that's still quite rare, but for example, token burn, or is there value accrual, and is there a mechanism, or is there the promise of that mechanism in the future? So it could be that an early stage project, for example, Uniswap says, not yet, first we need to get established, get the network effects growing, but obviously it is assumed that will change in future, and basically there is revenue there generated, and somehow that finds its way to the token. So that's, to me, that's kind of one family of types of tokens or ways that value can accrue, and the other is that there is reliable, predictable demand, and I don't mean investment demand, but demand for its use, for its use case. And I think that applies to my mind, that applies to so-called cryptocurrencies or currencies as well, because ultimately, to the extent an economy needs a currency to function, that demand for the currency is predictable and reliable, and sort of it changes on the margin, but basically it's there. And then the question is, can cryptocurrencies displace some of the currency demand that definitely is there in the economy, or also in terms of store of value, so relative to precious metals, can some of that demand that's definitely there pivot to crypto, which it already has to some extent, and also how does that change over time in light of the macro picture? As it gets shakier, there's more incentive to pivot, and vice versa. And I think it has to be one of these two things. And I would also say that, for example, tokens that, let's say, I would call them the application layer, so smart contracts that sit on top of protocols, they're very poor money, and they're very poor store of value in the sense of, you know, comparable to precious metals, because they don't control their own security, they don't control their own infrastructure, and anything can be money in some sense. Ice cubes can be money, it's just not very good money. So I would say that for those types of, for decentralized applications, the tokens of decentralized applications, I think we can take that whole demand money off the table, and it's really about, are you generating a revenue, and is that going to find its way to the token? But the protocol layer, the underlying blockchains, it's possible that they can have value just because they're a currency or store of value that is reliably demanded out there. And maybe just one small thing that I would say, terminology is all over the place in crypto, utility tokens and digital assets, and people mean different things by the same words, or they mean, if they use different words to mean the same things. I think this is in a decentralized ecosystem. This is not surprising, and it's definitely the case in crypto. I personally prefer maybe the term crypto assets. Cryptocurrencies is of course somewhat contentious because it implies it's a currency and so much of it is not. But digital asset is all financial assets, to be honest, and most money, and it's a little bit too broad. So I prefer the crypto assets as it's more specific to what we're talking about.
Sure,
But,
no, that's helpful.
There's no consensus on terminology in the market, and to be honest,
No, there is.
because it's inconvenient, but it's a sign of a decentralized ecosystem. So it's just how it
and
is.
also of a young industry that is growing still, right? You guys talked a little bit about different types of tokens, and you mentioned Uniswap, and you talked a little bit about different sorts of maybe metals or security-esque tokens. But coming back to the sort of the market leaders, right, with Bitcoin and Ethereum, what would you say are the primary value drivers for these two? And maybe I give this to Reto.
Yeah, if we start with Bitcoin, Bitcoin was originally envisioned as a payment token, but then evolved into a store of value. And with Bitcoin, as with most new technologies, it's adopting along an S-curve. And an S-curve in a logarithmic form is a logarithmic growth curve. It looks like Bitcoin. That makes sense, because if there should be a connection between adoption, growth, and the price itself, then it has to be like that. But then, of course, the Bitcoin price is a nominal variable. That means the further the adoption, the more you also have to take into account monetary variables such as money growth, velocities, and so on. And these variables or changes in these variables shift the curve to the up or to the downside. So, for example, in the last 2 years, really interest rates increased a lot in the US from -1% to +2%. That means we had to adjust our forecast. That means we shifted the logarithmic curve to the downside. So real interest rates are one input variable into our model. Then you have on the supply side the halvening. Every 4 years, the Bitcoin supply growth is cut in half. Next year, it will be cut from about 1.5% to 0.75%. But we think this is not a major driver anymore, because it's a low number now. It's already lower than for gold, where the annual supply is around 2%. And if you compare that with the volatility of the demand side, and you also have to take into account that on the supply side, you also have the velocities. Supply is tokens times the velocity. Then we think that from a fundamental point of view, it's just too low to have a major effect. It could still be that from a psychological point of view, it could have at least next year still an effect. And then, I mean, in the long term, it could even get negative, the halvening, because in the end, it's the revenue for the Bitcoin miners. And if the revenues are cut in half, that's usually not so good for someone. And it was intended originally that the transaction fees of the Bitcoin protocol will compensate for that. But because Bitcoin is evolving into a store of value, only few transactions are made, and therefore the collected transaction fees on the Bitcoin protocol are low. And so we don't think that in the end we will have 21 million Bitcoins, but we think it will be more. And probably that is not a catastrophe, maybe only when it is published the first time, but I think it will not be after this happening here. And last but not least, energy consumption. In our view, this is a problem for Bitcoin. It already uses twice the amount of whole Switzerland annually. And if you expect, for example, a tenfolder in the next bull run, then the energy consumption, we estimate, would be around the whole of Western Europe. And there will be a time when there will be a lot of pressure from from the regulators or the authorities, but also from a reputational point of view, we think usually these are the young ones that use the Bitcoins. And we know that the young ones get greener and greener because they care about their future. So we think Bitcoin will not be the star performer from now on, and we like smaller tokens or altcoins.
Interesting. Jeff?
As I said before, I don't think you can value Bitcoin. I think you can trade it. I think you can think about it in relative terms versus other things. I've never seen a great report on how to value gold, and I've never seen anything even remotely competent or interesting about how to value Bitcoin. I think it's guesswork at best. I think it's pretty binary, right? It's either worth basically nothing, or it's going to be an actual, real, valuable, currency or store of value in the future, in which case it's worth, a multiple of where it is today, and everything in between is just a path function in terms of probabilities of whether it's worthless or whether it's worth a lot. Ethereum is different, though. I think you can absolutely value Ethereum. There's two ways to think about Ethereum, right? One is as a company, because Ethereum does actually produce real revenues and cash flows. I mean, you can look at something like Token Terminal, for example, if you want to see the revenues and fees of businesses. Or any other sites if you're familiar with Nansen or Glassnode or others. But Ethereum does generate real fees. And then as a result, you can look at those revenues and try to value it from a cash flow standpoint like a company. I don't think that is the best way to do it. Another way to think of Ethereum is almost like a nation state, where Ethereum is a nation and ETH is the currency of that nation. In the sense that, think about like if you were to imagine you just found a new island in the middle of the Pacific, right? On day one, you finding that island, that island has some speculative value, even though there's nothing built on it. But there could be a future one day where there's real GDP, where there's schools and roads and businesses and economic activity. A layer one protocol is kind of the same thing. On day one, it has some speculative value when you launch a layer one protocol, because you might one day see a lot of things built on that protocol. The Apple App Store is another example, right? The day the App Store was released, there weren't a lot of apps in there, but you could see a future where there would be a lot of applications built inside of it. So, on day one, Ethereum had some speculative value in the sense of this is a new nation and we might see some GDP happening in that nation. And now you can see it actually happening. There's DeFi, there's NFTs, there's stable coins. There's a lot of different types of applications that are now being built in nation, similar to roads and schools and businesses. And as those applications get built, they generate transactions and fees, similar to tax revenue. I think that's probably the best way to do it, is you think about it in that terms. And then ETH then has a dual value proposition, right? On the one hand, it has value again within its own economy as financial transactions, as revenues. On the other hand, it has a utility value to it, that you actually need to own some ETH in order to participate in that ecosystem. So it's not a clean analysis where you could look at it just in dollar terms per se, or just in euro terms, because you're kind of thinking of it, in and of itself, the same way you would think of how valuable the dollar is within, the global world, or how the euro is. But I do think it offers some potential to have an upside valuation, right? If you believe in a world where there's going to be 100x transactions happening within this Ethereum ecosystem, then you can start to value, well, what would that mean in terms of block space available? What would that mean in terms of, fees and revenues that are produced? And also, how much of the Ethereum in circulation, the ETH in circulation, would need to be held just like cash is held in order to, use for transactions, right? Most people hold some element of cash in a checking account or in a savings account because of future needs. This is why I think the space is so interesting is you hand 10 equity analysts the same inputs, they're going to give you largely the same output. You give 10 digital asset investors the same inputs, you're going to get 10 wildly different outputs. And that might be frustrating to some because it's not clean, but it's also where alpha is created, in the sense that somebody's going to be right. And, in 50 years, there will be a textbook about how to value digital assets, in the same way that we have Graham and Dodd for equities and we have Frank Fabozzi for fixed income.
Yeah, I really agree, and it's also this many answers to how much it's worth and very varying approaches. I think it's also partly just, it's just the early stage nature, right? So if any early stage industry, if you asked in 1992 how would you value internet stocks or high growth stocks, I think it's always a little bit difficult to quantify something where all of the possibilities lie very, very far in the future, and it's kind of quite speculative to predict that growth. And I really like what you said, Jeff, about that the value comes from several buckets, or there's several components to it. For example, for Ethereum is the transaction fees that are being earned by the protocol, and as a validator you can earn some of those fees, so you would want to hold the token, so you earn the transaction fees as validator, basically through the staking yield in that case, but also because you need to use the currency in that economy, you have demand for the currency, you have to use it to pay for transactions and so on and so forth, and kind of both of them come into it. But for that reason, I think it's also interesting to think about protocols that charge very, very, very low fees, and there are some that charge none. And to my mind, if a protocol charges very little or almost nothing for using their services, then the token doesn't have a lot of value, to be honest. And unless you can assume that the cheaper cost will get them so much greater market share that basically it balances out. But having a sort of not dominant market share and very, very low fees, there's actually not that much that finds its way to the token. Even if there is an economy where it is demanded as a currency in that economy, all of that still holds true, but that doesn't add up to a lot of value. If we sort of really, really go through the numbers and do the maths, it's very hard to imagine a world, unless you're a dominant protocol, to sort of make it go far if you're not charging very much at all. And finally, I just want to come back to Reto's point, and I think I also see very interesting points that you make about the long-term future of Bitcoin, and I think there it's also a question of, is it going to be Bitcoin or Ethereum? Because there's the energy problem, but then Ethereum doesn't have that. Now the kind of the supply-demand dynamics on Ethereum with the burn are actually really healthy and really interesting. So Ethereum as money is not a bad proposition. And I know the flippening has been a long running story, and but that's always on the table, that if somehow the drawbacks, Bitcoin still has the overwhelming brand recognition. If people buy crypto and they either, and for payments in countries where, for example, there's hyperinflation, they go to Bitcoin and stable coins, and not really the other cryptos don't have that name recognition in the same way. But it could certainly change for the reasons you mentioned, that there's problem with the energy consumption. It's not even what kind of energy you use, it's just the sheer quantity of it. If you need in the entire world's energy supply to keep a network running, once it has grown significantly in terms of usage, that's not a reasonable proposition. And that's where also the proof of stake and proof of work debate comes into it. And of course, it's fully, the possibility is there for Bitcoin also to pivot to proof of stake. And I think not that there's any suggestion that it would, or any intention, but hypothetically, that's also a path if the other path becomes very difficult and very, very unattractive. And basically, proof of stake protocols are just more valuable because the transaction fees stay within the ecosystem. They basically find their way somehow to the token or the treasuries, and it's all sort of stays within, and proof of work leaks it to miners.
Yeah, we also like more tokens like Ether, Ethereum, where we have cash flows, and where we can do a multiple analysis or kind of discounted cash flow analysis. In the case of Ethereum, we come up with a 2025 multiple price earning ratio of 10 and a dividend yield, staking yield of around 5%. And certainly if you compare that with the NASDAQ, that looks quite attractive. The question is if it also looks attractive to altcoins. Ethereum for us is not an altcoin anymore. And there we are not sure, because on one side we think that Ethereum is Microsoft of the blockchain world. On the other side, we also think that Ethereum is the Nestlé of the blockchain world. That means we think Ethereum is the most conservative investment you can find in the blockchain world. Currently, more conservative than Bitcoin because of the cash flows, and therefore we are still a big fan of Ethereum. We had a very large position at the beginning of the year, but we have started to reduce it and to go more and more into some altcoins.
I love that you're talking about altcoins, because that's actually a good segue to my next question as well. When we're talking about Bitcoin, as you mentioned, Katalin, there's a lot of brand recognition, and I think that's starting to be true for Ethereum as well. But how do you kind of adapt these approaches when you're thinking about slightly less established crypto assets? Ones that are newer, ones that have maybe a lower TVL. How do you come at valuing these then? Maybe we start with Katalin.
Yeah, I think it's what Jeff already mentioned, that the more early stage you are, the more speculative it is. It's kind of it's the same. You look at it the same way, but you just have very, very few proof points. It's all a promise, and you don't yet, like you mentioned, Jeff, like the roads are not yet, you don't see the workmen in the orange or high-vis vests building the roads yet, but there's the potential, that there's the intention that that's what they would do. So the more proof points you get, obviously your forecasts keep narrowing, and you can have more and more and more certainty in them as you see an ecosystem building and the network effects taking effect. And when you don't yet have that, it's obviously highly speculative. And then you would look for, I think in the case of blockchains, you really just look for, is it bringing anything to the party, especially in this now fairly mature ecosystem of layer ones? Are they bringing anything to the party that really is value added, that the ecosystem doesn't already have? And I think at this point that's quite hard to do, because so much of it has already been done. But any innovation that really fixes some kind of a problem that the big layer ones haven't solved yet would be legitimate. But I think kind of more of the same now it's hard to see. I think also the trend is towards, the beginnings of a trend towards the shared security and potentially, through, say, the eigenlayer on Ethereum, or Cosmos has a similar, they have a similar way of working, and that basically it could be that the layer one ecosystem now congregates into a small number of protocols that provide the security, and the rest is all about customization, scalability, app specific, sector specific, and so on and so forth. I mean, this is sort of speculative, but now if we see a new project, you really have to, you really have to see what do you bring to the table that would allow you to build an ecosystem. Will you be able to hire the guys with the high-vis vests to build the roads that you envision, or that they're already fully engaged elsewhere and not much room left for you.
Sure. Jeff, do you want to add?
Yeah, I mean, this may come as no surprise, but I also hate the term altcoin, because altcoin gives some sort of a connotation that there's, Bitcoin and Ethereum and then everything else, and that's ridiculous, right? I mean, that'd be like saying that every stock that isn't Apple is an alt stock. You can have smaller stocks and bigger stocks. You can have small companies and bigger companies. You can have, profitless companies, and you can have, high dividend companies. Like, there is room for all of these different things. and to generically label all of them that isn't Bitcoin or Ethereum as, this other pile is kind of ridiculous. What I do think, though, when you're looking at different types of these emerging tokens, it starts with, again, kind of understanding what is the purpose, right? There's a lot of projects that have issued a token that don't need a token. The token has absolutely no bearing on what the project is, and you shouldn't buy those. I mean, those, if a team that has issued a token can't answer why you have a token, then that's a pretty good reason to stay away. There's others where maybe the token is important, but you just haven't gotten anywhere close to critical mass yet. Even some of the biggest, most well-known applications and protocols that are number one in market share in their respective, subsets, still have barely any users relative to some of the high-flying tech companies. I mean, look at like what ChatGPT did in a month compared to some of the, we were talking hundreds of millions, if not a billion users. I mean, the best protocols and applications in crypto have maybe 1 million users. A lot of them have tens of thousands. So there's still quite a bit of growth that needs to happen before any of these kind of hit any sort of like critical mass where they're going to grow into their valuations. One simple way to think of, we'll just use layer ones because Katalin was talking about it. Use layer one blockchains for an example, right? I mean, again, I always think of them as app stores, right? Each new blockchain is its own app store, and ultimately, are you going to fill it with apps? Ethereum clearly has the most applications right now. So think about, what is a layer one blockchain? It is a business that sells block space. So in 2021, you had enormous demand for block space and not enough supply. At the time, prior to 2021, Ethereum had like 95% market share of layer ones. By the end of 2021, Ethereum was down to like 60%, and you had Solana and like Near and Algorand and Phantom and Luna. And why was that? Well, because Ethereum ran out of block space relative to the demand, so there was new layer one protocols that were filling that block space to transact in. And that's because you had this rush of NFTs and DeFi and stablecoins and all these things that were utilizing that block space. Well, now you go into 2022 and into 2023, where there's a lot less demand. Well, now you have an oversupply. You have all these layer ones and now layer twos. You basically have infinite block space and not nearly enough transactions to fill it. So again, kind of just understanding where we are is a huge part of identifying where you want to invest. We haven't really found the killer app yet, right? Stable coins are probably the best version of a killer app so far. And even that's only, $150 billion. I mean, compare that to, M2 money supply and all the, dollars and euros and yen and everything floating out on the road. I mean, it's tiny, right? I mean, it's nothing, compared to what those who believe in crypto think that could be. I mean, most of us think that, US dollar denominated stablecoins will be like a $10 trillion industry one day. When that happens, when you start to have real uses of NFTs beyond just, JPEGs, right? When NFTs represent things like your medical records, and they represent your social security, and they represent, the coupons that you use, and all these different other areas where NFT technology can benefit society beyond just, these art collections. And then you go back to a situation where you might have real pressure and demand for that block space again, and ultimately, there may be versions of layer ones and layer twos beyond Ethereum that do have real value because of that. So I look at things like Uniswap is by far the number one decentralized spot exchange, right? DYDX is 2/3 market share in decentralized derivatives. You have Blur, which is clearly number one in NFT transactions, right? You have all these different businesses, but they still have, hundreds of thousands of users, maybe millions. It's not hundreds of millions yet. When those numbers start to really grow, that's when you're going to see cash flows that are off the charts and demand that's off the charts relative to the amount of supply of these tokens. So, I think it's very case by case. I think it's hard to say I'm going to invest in this, type of token. I think you have to look at each of these individually and understand how far, how much demand is there right now for it? How, is the inflationary pressures of this token just so high that the demand will never catch up? Or are we hitting an inflection point where, you could get a 2021 like break where all of a sudden it's like, yeah, we actually have way more demand than there is space. And ultimately that means this token is going to go up 10,000%.
Reto?
Yeah, I see it a bit like Jeff, that not everything has to be on the blockchain, because the blockchain is a very inefficient database. You have thousands of copies. And if you compare that, for example, to Netflix, they need 3 copies, because when something breaks with 1 copy, they still have 2 and can make another 3rd one. So you always have to compare this inefficiency with the additional efficiency you get through automation. And if you are talking about the killer apps, then we think that the killer apps will be in DeFi, because there you move a lot of value. And we think the blockchain is made for the DeFi world. And we see a lot of projects now which look more and more interesting. When you look at the cash flows, these projects generate already at the bottom of the bear market into the consolidation here. Then you can imagine how much they will earn when we go into a bull market. So we see their most value, but not in Uniswap.
Yeah, and some of the analysis comes back to kind of old-fashioned competitive analysis. It's coming back to what you guys said, that when demand is growing very fast, then supply, it lets in more supply. And then the question is, what does a protocol do to actually capture that opportunity? And for example, do you cut your price, which is, for example, the BNB or Binance Smart Chain and Tron, they captured a lot of market share right off the bat, even though their product wasn't technologically superior in any way or very exciting, but commercially they were very savvy and positioned themselves in terms of the price point and availability so that they could capture a lot of market share. And this competitive analysis is also a part of it. If you're coming into a plentiful market where market share is up for grabs, then what is your strategy to be the guy who gets there? When you're coming into the opposite market, then really what is your added value? Why would anyone pivot to you when it's already, not rich pickings?
Sure. As you said, what are you bringing to the party? I see that we're kind of heading towards the end of time. So I would say maybe one more question, and each of you can maybe answer in 2 minutes or so. What are the common misconceptions that investors typically face, and what should they be aware of when attempting to think about investing in crypto assets? And I give this one first to Reto.
Yeah, I mean, the misconceptions, several, but I think you have to think about how you want to treat all these token issuance of the projects, because on one side this is yield, on the other side it's also expense, or at least at the beginning we thought that it's an expense, because when we did first our models, we treated issuance or inflation of new tokens as an expense. And then we got results which were not satisfactory for us. So we changed that, and now we treat it more than like bonus shares. And then it really depends. It can be dilutive, but it also can be accretive. It depends how the token inflation in total is. So it means if you get inflationary yield of 5%, but the token inflation altogether is 3%, then it's accretive to the token holder. And if it's the opposite, then it's dilutive. So this should be in focus, how you treat this in your models. And on the other side, other misconceptions. I mean, we are not fan of payment tokens. We think you don't need payment tokens. They will be replaced by stable coins, and it's extremely difficult to get a measurable velocity of the payment tokens. So we really stick with security tokens, although it's a dangerous word nowadays. And we look at the cash flows, and I think then you can add most value to a portfolio.
Katalin, you go next.
You know, but misconceptions, I just want to mention a quick one. It is that meme coins have any value. That's a fundamental misconception of anyone who's buying Peppercoin and things to make it into billions of dollars of market cap. You know, basically, that is where crypto becomes a casino. And I actually really don't like that these things even exist. They add to obviously transaction volume, so they might have some marginal benefits for the ecosystem, but it's very decredentializing because it's really something that is not useful and is not valuable either. And it's also not like NFTs, because anything that's art or collectible, then it's rare, and it has the value is that there's just one of that piece of art or even a collectible, but when it's infinitely divisible, obviously there's none of that there, and there's really nothing. The only thing that can redeem some of these projects is if they have some kind of a plan, which so far I have only really seen Shiba Inu, and I'm not recommending the token at all, but at least it's that they have a plan to say, we're going to create a community, we're going to have people come in and love the token and make it big, and then we're going to use that brand recognition to create DeFi and metaverse and gaming and sort of applications. Now, whether that's a good way to go about it or not is yet to be seen. I think that they haven't shot the lights out with anything that they have launched, but at least there is some legitimacy to that approach. But otherwise, it's one of the things I least like about the crypto market.
The gambling and the meme coins. And Jeff?
Yeah, I mean, first, I think, 5 years ago, the investors we spoke to really didn't understand anything. If they were investing in this space, it was a complete leap of faith, hoping that this might be something that they could strike it rich with. That's not true anymore. I mean, the questions we get now from LPs and prospective LPs are incredibly well thought out. It really shows that there has been a lot of education in the last few years and a lot of knowledge. There's plenty of times where I get asked questions now where I don't have any idea, because the end investor knows more than I do, because maybe they were privy to something new that I didn't see, because the industry has gotten so big where you can't just be a digital asset expert in everything anymore, right? 3 years ago you could. There was literally nothing that was happening in the market that I didn't know about. Now it's bigger than I can personally consume, and that's a good thing, right? I mean, you wouldn't expect a long short equity manager to have an opinion on every single stock, and the same thing is now true in the digital asset space. Where I do think there's misconception still is really kind of tied back to what we said earlier about just lumping everything together. For example, let's say you just came to Earth, from another planet, and the only thing anyone ever told you about the U.S. equity market was Bed Bath & Beyond and AMC, right? And you'd be like, what is this? I'm never going to touch this. Equities are clearly a joke, and I have no interest in this, right? For whatever reason, there's been 2 or 3 meme stocks that have taken on a life of its own that doesn't represent the rest of the U.S. equity market. The same is true to Katalin's point. Like if you just only focused on Dogecoin and Shiba Inu, you're going to have a completely wrong perception of what the digital asset space is. But unfortunately, that's the stuff the media likes to write about. That's the stuff that gets exciting on Reddit boards and things like that. So you do have to kind of understand that this industry, despite a lot of bad things happening, despite a lot of funny things happening, there is a real industry underlying this. And if you focus on that part of it, you know, it's pretty exciting, and there's a lot of different ways to value these tokens. There's a lot of different things to think about. There's a lot of, you know, capacity utilization that may or may not ever become, you know, fully tapped, and you know, it's frustrating to always have to answer the questions about FTX and about Luna and about you know, Dogecoin, but you know, at the same time, it doesn't take away from the fact that there is real value here, right? Just because the industry itself has maybe not agreed fully on a value proposition doesn't mean there isn't value. It just means that that value is somewhat opaque. So, you know, I think pushing through that noise and understanding what is real versus kind of what is a joke is really important. And I don't think the media really does a great job of that.
That's
you know, and if I could just add one more thing, it's actually the way we, you know, when people say, is crypto an asset class? Like, we increasingly answer that with saying, actually, it's an asset universe, because it's got such economically distinct market segments that are not at all like each other, that looking at it as a mass, as a blob, doesn't make any sense of it. It really has distinct market segments that are maybe asset classes in their own right, or are maybe similar to traditional asset classes, some of them in some way. But you really cannot wash crypto together and say, here's an asset class for you.
That's a good note, I think, for us to wrap things up on. A big thank you to all of you for coming in today to share your insights. There's obviously just so much more to still learn about this industry as it evolves. It's evolving in real time. And hopefully we can do this again and keep learning as we go. For our listeners, feel free to, you know, write to us if you've got questions. But more importantly, there's also a link in the chat where you have our report on valuing crypto assets, which you can download to learn a little bit more about what our experts were speaking about today. And then until the next time, thank you all so much.
Great. Thank you, everyone.